Many people think Social Security is simple. They believe it's a straightforward process, easy to grasp and manage. You pay in diligently throughout your working years, and you expect to get it all back at retirement. It feels like a personal savings account, a dedicated fund ready and waiting for you after decades of hard work and contributions. But that's not how it actually works in practice. The reality is often more complex than it seems. The truth? Let's uncover the facts. Social Security benefits, surprisingly, can be subject to taxation. This often surprises many retirees who fully expect their payments to be completely tax-free, a source of guaranteed income. Why does this happen? What are the underlying reasons for this unexpected tax burden? Because of rules and regulations that were established decades ago, shaping the current landscape. If you have other sources of income in retirement beyond just Social Security, a portion of your Social Security benefits may indeed be taxable, impacting your overall financial picture. What initially started as a tax intended for the wealthiest individuals now affects a significant number of middle-income retirees, broadening its impact considerably. The income thresholds used to determine the taxation of benefits haven't been adjusted to keep pace with inflation, unfortunately. So, as a result, more and more people are finding themselves paying taxes on their Social Security benefits every single year. This isn't about being cheated or misled. It's simply about understanding the existing rules and how they apply to your situation. Understanding the intricacies of how Social Security is taxed is the crucial first step towards effective and smart retirement planning, ensuring a secure future. In this comprehensive guide, we'll break down all the relevant rules and regulations specifically for the 2025 tax year. We'll bust the common myths and misconceptions and explain all the necessary calculations in plain, easy-to-understand English, avoiding complex jargon. You'll learn exactly how your total income from all sources and your chosen filing status can significantly affect your overall tax bill. Knowledge is power, especially when it comes to managing your retirement finances effectively and confidently. By the end of this guide, you'll know exactly how to plan proactively and avoid any unpleasant surprises when tax time rolls around each year. Don't let outdated myths and misinformation trip you up along the way. Social Security isn't just a simple give-and-take arrangement, it's more intricate than that. It's a complex system with specific rules and regulations that you absolutely need to understand to navigate it successfully. So, let's get started right now and make absolutely sure that you're fully prepared for the road ahead. Your retirement truly deserves clarity and peace of mind, not confusion and uncertainty. Let's dive right in and take firm control of your financial future, ensuring a comfortable and secure retirement. Here's everything you need to know about Social Security taxes for the 2025 tax year. Each year brings changes to Social Security and taxes. For 2025, expect a modest cost of living adjustment, likely around 2.5 to 3%. This means your monthly benefit will rise, but so could your tax bill if the increase pushes you into a higher bracket. Tax brackets and the standard deduction are also rising with inflation, letting you earn a bit more before paying higher taxes. Seniors get an extra standard deduction, reducing taxable income even further. But here's the catch. The income thresholds that trigger Social Security taxes haven't changed since the 1980s and 1990s. So, while your benefits and deductions rise, the tax trigger stays frozen. More retirees are taxed each year, a stealth tax that catches many off guard. Stay alert to these changes. Small adjustments can make a big difference in your retirement budget. Understanding the 2025 updates helps you plan smarter. Many believe Social Security is always tax-free. It's not. If your provisional income is high enough, up to 85% of your benefits can be taxed. Provisional income includes your total income plus half your Social Security. Only a portion of your benefits is ever taxed, never the full amount. Even modest pensions or part-time work can push you over the tax threshold. This isn't just a rich person's tax anymore. Working in retirement doesn't automatically mean a huge tax bill. You have control. By managing your income sources, you can limit how much of your benefits are taxed. Understanding these rules lets you plan withdrawals and work hours wisely. Don't let myths lead to costly surprises. Know the facts and you can make smarter choices. Let's clear up the confusion and take charge of your retirement taxes. Let's delve into a crucial aspect of Social Security. Understanding how your benefits might be taxed. It's a topic that can seem complex, but with a clear explanation, you can navigate it with confidence. The key to determining if your Social Security benefits are taxable lies in calculating your provisional income. This calculation is the first step in understanding your potential tax liability. To calculate this, you'll need to add together several components, starting with your adjusted gross income, often referred to as AGI. This is a key figure on your tax return. Next, include any tax-exempt interest you may have received, such as interest from municipal bonds. Finally, add half of your Social Security benefits to the total. This combined figure is your provisional income. Once you've calculated your provisional income, the next step is to compare this total to the IRS thresholds. These thresholds determine whether your benefits will be subject to taxation. For individuals filing as single, if your provisional income is below £20,000 or $25,000, your Social Security benefits are generally not taxable. If your income falls between £20,000 and £27,000, or $25,000 and $34,000, up to 50% of your benefits may be taxable. And if your provisional income exceeds £27,000 or $34,000, up to 85% of your benefits could be subject to taxation. For married couples filing jointly, the thresholds are different. If your combined provisional income is below £25,000 or $32,000, your benefits are typically not taxed. If your income is between £25,000 and £35,000 or $32,000 and $44,000, up to 50% of your benefits may be taxable. And if your combined income is above £35,000 or $44,000, up to 85% of your benefits could be taxable. As you can see, the higher your provisional income, the greater the portion of your Social Security benefits that may be subject to taxation. It's important to remember that the tax on Social Security benefits phases in gradually rather than all at once. If your income is under the first threshold for your filing status, you're in the clear, and your benefits are generally not taxed. However, if you cross into the next tier, a portion of your benefits becomes taxable, depending on how far above the threshold your income is. If you go above the top threshold for your filing status, then up to 85% of your benefits are included in your taxable income. Therefore, understanding these income tiers is essential for smart retirement planning and managing your tax liability effectively. It's a good practice to calculate your provisional income every year, as your income and benefits may change over time. By staying informed and understanding where you stand in relation to these thresholds, you can stay ahead of the taxman and make informed financial decisions. Filing status matters a lot. Single filers face lower thresholds than married couples, but the joint thresholds aren't double. This creates a marriage penalty for some. For singles under £20,000, $25,000, no tax, £20,000, £27,000, $25,000, $34,000, up to 50% taxable. Above £27,000, $34,000, up to 85% taxable. For married couples, under £25,000, $32,000, no tax, £25,000, £35,000, $32,000, $44,000, up to 50% taxable. Above £35,000, $44,000, up to 85% taxable. Married filing separately, almost always up to 85% of your benefits are taxable. The tax code discourages separate returns for couples living together. Know your filing status and thresholds. The right choice can save you money. Don't let a technicality cost you at tax time. Let's put these concepts into practice and see how this works in real life with a few different scenarios. We'll explore how these rules impact individuals and couples with varying income levels. First, let's meet Betty. Betty is single, 70 years old, and living comfortably but carefully. She receives £16,800 annually in Social Security benefits. This forms a significant portion of her income. In addition to Social Security, Betty also earns £1,200 in savings interest each year. Now let's calculate her provisional income to determine her tax liability. Her provisional income is calculated as £1,200, her savings interest plus half of her Social Security, £8,400, which equals £9,600. Because £9,600 is well below the threshold for her filing status, Betty pays no tax on her Social Security benefits. Now let's consider Frank. Frank is also single, and he receives the same amount in Social Security benefits as Betty, £16,800 annually. However, Frank also has a pension that provides him with £15,000 per year. Let's calculate Frank's provisional income to see how his pension affects his tax situation. His provisional income is £15,000, his pension, plus £8,400, half of his Social Security, which totals £23,400. This puts Frank between the lower and upper thresholds for single filers. As a result, up to 50% of his Social Security benefits are subject to taxation. This could significantly impact his overall tax liability. Now let's shift our focus to married couples and meet George and Mary. They are a married couple filing jointly, which changes the income thresholds. Together, George and Mary receive £28,000 in Social Security benefits annually. They also have a combined pension income of £10,000 per year. Let's determine their provisional income to see if they will owe taxes on their Social Security. Their provisional income is £10,000, their pension income, plus £14,000, half of their Social Security, which equals £24,000. Because £24,000 is under the joint threshold, George and Mary will not pay taxes on their Social Security benefits. However, let's consider a hypothetical scenario. If their pension income was £20,000 instead, their provisional income would increase to £34,000, and now up to 50% of their benefits would be taxable, potentially leading to a significant tax bill. As these examples illustrate, even small changes in income can have a substantial effect on your tax liability related to Social Security benefits. Therefore, it's crucial to calculate your provisional income accurately to avoid any unexpected tax surprises. These examples clearly demonstrate why careful financial planning is so important, especially in retirement. What counts as income for Social Security taxes? Wages, pensions, withdrawals from traditional IRAs and 401ks, interest, dividends, and capital gains all count. Roth IRA withdrawals don't count, they're tax-free and don't raise your provisional income. Gifts, inheritances, life insurance payouts, reverse mortgage payments are also excluded. Balancing withdrawals from taxable and non-taxable accounts can help you manage your tax bill. Use Roth accounts strategically to keep your provisional income low. Not all money you receive in retirement is treated the same. Know what counts and what doesn't. Smart planning can save you thousands. Make your income work for you, not the tax man. Don't wait until tax time, plan ahead. Request tax withholding from your Social Security using Form W-4. V. Spread your tax payments throughout the year to avoid a big bill. Be strategic with retirement account withdrawals. Use Roth funds for big expenses to avoid raising your provisional income. Keep organized records of all income sources and benefit statements. Estimate your provisional income during the year and adjust withdrawals if needed. Consider professional advice. A retirement tax specialist can help you save and avoid mistakes. Small steps now can prevent big headaches later. Stay proactive, not reactive. Peace of mind is worth the effort. The biggest lesson for 2025? Be proactive. Social Security isn't always tax-free. Know the rules. The tax thresholds haven't changed, so more retirees are affected each year. Calculate your provisional income, AGI, tax-exempt interest, half your Social Security. Use Roth accounts and smart timing to keep your income below key thresholds. Withhold taxes from your benefits to avoid surprises. Use the higher standard deduction for seniors. Plan your withdrawals and income sources carefully. A little knowledge and planning go a long way. Take control. Enjoy your retirement with confidence.